sell your house, you walk away with a $400,000 profit. And the IRS takes nothing. That's not a loophole. That's not a sketchy tax shelter. That's the law. It's called the Section 121 exclusion, and it's probably the biggest tax break you'll ever qualify for. But there's a trap buried inside it from 2009 that almost nobody talks about, and it can quietly cost you tens of thousands of dollars if you don't see it coming. Stick with me, because by the end of this video, you'll know exactly how to claim the full exclusion and how to avoid the trap that ruins it. Okay, the basics. If you sell your primary home, you can exclude up to $250,000 of profit from your taxes if you're single. $500,000 if you're married filing jointly. Profit, by the way, doesn't mean the sale price. It means the sale price minus what you originally paid, minus your closing costs, minus any major improvements. So if you bought a place for $300,000, dumped $50,000 into a new kitchen and roof, and sold it for $700,000, your taxable profit isn't $400,000, it's $350,000. And if you're married, all $350,000 is tax-free. To qualify, you need to pass 2 tests. You had to own the home for at least 2 of the last 5 years, and you had to live in it as your main home for at least 2 of the last 5 years. 2 years, that's it. They don't even have to be consecutive. Now here's where most videos stop. But here's where the 2009 trap kicks in. Before 2009, you could buy a vacation home, rent it out for years, then move in for 2 years, sell it, and shield the entire gain. People were gaming it hard. So Congress changed the rules. Starting January 1st, 2009, anytime you owned the home but didn't use it as your primary residence counts as non-qualified use. And that portion of your gain, not excluded, you pay tax on it. Here's a real example. You buy a condo in 2015 as a rental. You rent it out for 6 years. In 2021, you move in, live there 2 years, and sell in 2023 for a $200,000 profit. Old rules, all $200,000 tax-free. New rules, 6 out of your 8 years of ownership were non-qualified. So 75% of your gain, $150,000, is fully taxable. Only $50,000 gets the exclusion. That's potentially a $30,000, $40,000, even $50,000 tax bill you didn't see coming. So how do you actually use this rule the smart way? 1. If you're buying your first home, just live in it. 2 years minimum. Sell whenever, take the exclusion. Easy mode. 2. If you ever convert a rental into your primary home, understand that the years it was a rental after 2009 will eat into your exclusion. It's not all or nothing anymore. 3. The reverse is fine. If you live in your home first and then convert it to a rental later, those rental years generally don't count as non-qualified use, as long as you sell within that 5-year window. That last one is huge. It means you can live somewhere for 2 years, move out, rent it for up to 3 years, and still claim the full exclusion when you sell. That's a legitimate strategy real estate investors use to build tax-free wealth, one house at a time. The Section 121 exclusion is one of the only places in the tax code where the government basically hands regular people a 6-figure tax break. Just know the rules before you make the move, not after. If you wanted to go deeper, the next video breaks down how to stack this exclusion with a 1031 exchange. That's where things get really interesting. Drop a comment if you've ever sold a home and had no idea this rule existed. I'm curious how many of us missed it.